Hey, good morning, everyone. Marty Missouri here, 9th of August, 2019, Friday. I'm going to take you right back to where we left off yesterday on the S&P 500 daily chart. We were sitting right here at the time I spoke at you yesterday, and I was pointing to the top of this gap where we gapped down on Monday and suggested that we would see the market probably struggle pretty mightily right in there. And then right about here, it would have to contend with a 50% retracement from this level here, top to bottom, actually here, top to bottom, and then back up. I explained yesterday, I'll show you again how 50, actually 38.2 and then 50% and then 61.8 retracements tend to be places where snapback rallies tend to give up the ghost. So we had two levels of resistance right here that I was talking about. I even said expect the market to really struggle in here. And I even suggested that, my view was that we would resolve lower. But I also said that if we break through this area, with some momentum, that it's my guess that there are some shorts already there, some shorts piling in, folks ready to sell this market. Well, if they're short and you go through there with good volume, good breadth, good momentum, which is exactly what happened yesterday, then those shorts are going to cover. Because if you short something, you sell something you don't own, and as it continues to rise, between then and when you have to deliver it, you can lose a mountain of money. So folks obviously don't want to do that. So they have their stops in here. They end up covering their shorts or buying those stocks. And of course, you know what happens. Then you get an exaggerated move higher. Just like when stop losses are hit down below some level, you get an exaggerated move lower. And then the bulls are emboldened, thinking, oh, yeah, people are getting smart. Well, no, they're actually getting scared. They're buying out of short positions. Or the bears say, yeah, people are piling in. And so no, they're just getting stop losses sold. So be wary of putting too much faith in a short term move when we're looking at some key levels, because a lot of times it's just portfolio repositioning. It's not that the shorts have gotten resoundingly bullish. It's that they got scared away in this example. Be ready for them to come back at certain levels if their theses are still intact, if they're still bearish. So I did say that on a near-term basis, I'm not constructive on stocks, so it wouldn't surprise me. My base case would be this looks a lot like these other nice big rallies with big green candles, only to fail. But that remains to be seen. I showed you a bunch of these yesterday. Doesn't have to be that way. In fact, I'll be happy to change my tune if we can go up through here with some momentum. But we still have the real fundamental underlying stresses that don't look like they're going away anytime soon. Okay, so as we update the chart, first thing I want to do is take a look at the 1 minute chart and see what happened here. Remember I said this 25.15, 25.16 level. So we were doing that video somewhere in here. And sure enough, for, the better part of a half hour or so, we hit the top of that gap, came down, struggled with it for a little while, but we didn't sell off of it like you could tell I expected. No, quite the opposite. We actually came up, gained a bunch of momentum, moved into this phase right in here, and then and really sat there with some really nice gains all day. And the bulls and bears just kind of battled it out. No doubt I could zoom out and they see some established past resistance and support line right there. And then finally broke out of it and had a nice move toward the end. That was a nice bullish move at the end of the day. How does that look in terms of our retracements? Well, here's yesterday's candle. So I showed you the minute chart, but ultimately on a daily basis, blew right through the top of that gap and blew right through the 50% retracement and closed kind of midway between the 61.8 and the 52. Remember that these three are key. Back in here, it was the 50% retracement back here in May is where the market stalled out. And as I showed you yesterday, back during the big fourth quarter 20% correction, it was the 61.8 was right where it failed the first time. Then we came down. We actually came back up again, tested about the 50, and then came all the way down, and we had that big correction. That was back then. This is the May correction. So this morning is going to be interesting to watch in terms of these technical levels. I think we're looking at the same scenario. We've got probably some shorts just beginning to pile up right in here, right at the top of this candle right here, looking for the market to resist that. Again, we break through these key levels. If we continue to do like we did yesterday, with momentum, those shorts are going to have to cover, and we're going to continue to get a push higher. Now, a technical perspective, this could undo some damage, and it could create some momentum, and we could very well be right back up here to all-time highs. Even on a near-term basis, that's not my base case. It wouldn't surprise me if this looks something like these other waves and retracements that we have back in here. Right now, as I speak, looking at the futures market, if the Dow were to open right now, it would open down about 105 points. The S&P 500 would open down about 14 points. So we would come back and fall down in here, somewhere in this level, right back below this 50% retracement level. And if we do that, we come down there, then I'm going to be looking at this and see that it failed right there at the 50%. But folks, all this remains to be seen. I think these are good exercises for us because it helps me help you put all this short-term noise into perspective. What we really want to pay attention to is the deeper fundamental analysis, which we get into a lot on the written blog. I have expressed my concerns about the state of the corporate debt market. I talked about triple B rated corporate debt and how that's the last tranche of investment grade debt, and how if triple B debt gets downgraded, the rush of selling that's going to go in and hit the corporate debt market. Just to real quickly illustrate what I'm talking about, here is the amount of triple B corporate debt issuance out there, and this is just the last couple of years. So you can see the trend here of late. So that's kind of what I'm talking about. So we're talking about growing recession risk, which is definitely what we're seeing. Yeah, we're certainly seeing it in treasury yields and treasury curves and these things that economists get worried about. Then we start looking under the surface and say, okay, what could really crack if we had a bad recession? I'm seeing some things in the corporate debt market that make me uncomfortable, that could really exacerbate a downturn, which helps explain why we're feeling that it's smart to kind of move a bit to capital preservation mode, not essentially ripping portfolios out of cyclical sectors, but hedging a bit using derivatives. I think being smart, willing to give up some upside to protect against some downside when, if we do continue geopolitically to put stress on the global economy, and ultimately we do roll over, it could be painful when things like triple B corporate debt unwinds. Another way to look at it too is just simply, just let me draw over here in the blank. Right now we have a waning fundamentals. We have our own macro index and it's been declining. We've got consumer data that's been rising. We have good job. We had great jobless claims yesterday, pretty good retail sales, really good consumer sentiment right now. So we have a consumer that's doing really good and consumer data that's doing good. We're having more of the industrial data, the credit markets, the signals they're sending and so forth, actually going in the opposite direction. So this is going to be resolved one way or the other. Either all this activity up here in services and in the consumer is going to begin pulling up the data and it's going to resolve better, and we're going to continue with this expansion, which by the way, folks, means inflation and higher interest rates. Ultimately, that's a good thing. That's what you look for in the late stages. What we're seeing right now is the kinds of things you see when recessions are beginning. You see things rolling over, you see yields tank, you see inverted yield curves and things like that. So the other scenario is that ultimately it's just the consumer up here is living with a false sense of security, not aware of what's happening. This begins to bleed into the consumers' lives, layoffs in the manufacturing level and so forth. And then suddenly we have this roll over. The stock market, no doubt, is helping the consumer. Have a job, my 401k is bulging, life is good, let's go on vacation, let's go out to dinner, let's go, in essence, stimulate the economy. Stock market begins to roll over. If it does, under the weight of some of these geopolitical concerns, if the consumer rolls over with it and then we end up in a downturn, then I've got some worries. The federal government cut taxes. You have to ask how much fiscal stimulus is going to be there. We know where the Fed is in terms of interest rates being incredibly low already, size of its balance sheet and so forth. not to be dire, not I don't want anybody out there losing sleep. I just want clients to understand why they're hearing a much more guarded tone or tune from me, and why we're having discussions about how to hedge portfolios against the potential for something that could morph into something ugly sooner than we otherwise expected as recently as just a few months ago. Okay, so I'll leave it there. Thank you once again for watching and listening, and of course I'll be back very soon. Take care.